All right, check, check, radio check. Whoops, I advanced without intending to. So, want to thank everybody for taking time out of your busy schedules, joining us here. I haven't seen some of you in a while. Some of you I saw on Facebook. So, one shout out to David and Martine. Happy anniversary. So, I saw that recently. I just wanted to say congratulations and I hope you're doing well. We're going to talk about September is Life Insurance Awareness Month, and there is a strategy which we've been utilizing in our office for about 10 years, and it's called Kai-Zen. Kai-Zen is was orchestrated by a company called NIW, but really it's one of the least riskiest premium financing systems I've seen in my career. I've vetted it. I've utilized it with clients. As a matter of fact, I just had a client approved who is of their own money putting in $250,000 a year for 5 years. And we're going to go into that. Now, I've talked about this in the past, but this year I was fortunate enough to go to a master class, and they shared with us a slide deck that I'm going to take us through now. And if you're on this call, or if you have somebody in your family that you think might or should consider this, then please have them reach out. Normally, these calls, if you've not been on this before, typically are 15 to 30 minutes. This will probably run a little closer to 30 minutes today. And again, I want to thank each of you for coming out and spending time. And without further ado, we'll get started. For those of you that don't know me, I am a financial advisor, have over 30 years experience. I have some letters after my name. You can look me up, Google me. I'm not going to spend a lot of time talking about my accolades and my designations. But let's start with financial planning considerations, right? As we progress through life, as we're working, raising families, getting to the point where we say, hey, I'm done, and I just had a call with a client today who's 68 years old, and they're nervous, right? Because have they saved enough? And so some of the risks that we're typically faced with is longevity would be the first one. And I say when I'm doing my public classes, I think this is one of the greatest risks as we as Americans face, because longevity is not only a risk, right? Living to, age 100 or what have you, but it's also a risk multiplier. It means that the rest of these risks that we're about to show you could happen over the next 10, 20, 30, 40 years multiple times. And that's why I think it's one of the ones that really should be addressed. And then you have liquidity risks. We need to make sure we can access funds when we need it. Inflationary risks we're going through now. I've been touting that from the rooftops for about the last 15 years, and now it's starting to rear its head. It's come back a little bit, but we have to be cognizant of inflation. Market, we've seen it the last couple of days, and we will continue to see volatility. And this is really where I think a lot of people make mistakes. They're putting all their efforts into this arena because they are not sure of any other options. And so we're going to talk about that. Mortality, obviously, I think, I say risk or death is always premature, right? But if that does happen to you, your family, your loved ones, what happens? How do they get by? And are your affairs in order? And then we always talk about this. If you don't learn another thing from me, it's the taxes, it's the taxes, it's the taxes. So as we're working with clients and helping them to start to develop a plan, creating tax-free income is really a central point of our conversations. So here's the problem. According to the Bureau of Economic Analysis, U.S. Department of Commerce, and T. Rowe Price, the average savings rate for most Americans is between 3 and 5%. That's the average, right? Now, if you're in the top 10% of average income earners, maybe it's a little bit higher, 9 to 12%. But what the experts are saying that really you should be able to retire in the future, you should be saving 30 to 35% of your income. A third. So just think about it. If you're making 100 grand a year, taxes come off. Let's just say you're in a 25, 30% tax bracket. So that leaves you with 70. You should be putting away 30 grand, 25 to 30 grand And are you doing it? Again, I was speaking to a client today. She was 68. She was maxing out because of the Roth provision, or the catch-up provision. But one of the things that in the back of my mind I'm thinking is here you are putting away $30,000 at a point in time into a tax deferred environment. And that creates back to the last slide where I was talking about risk. It's the taxes, it's the taxes, it's the taxes. So really, I think I'm a big proponent of strategizing to create tax-free income, and that's what Kai-Zen will allow us to do. And for those of you that don't know, Kai-Zen is a Japanese term that means continuously improving. And I really have. That's part of the way I gravitated. For those of you know me, know I'm a martial artist. I'm very into philosophy and things of that nature. So this is why I gravitated towards this system anyway. I'm very risk averse. And so I vetted this and looked at this, and my clients that have participated in this have been extremely pleased. But you have to understand it. So here's a common misconception. People typically are taught that it's the rate of return is the primary factor. And if they're not getting enough rate of return, they're told that they have to go out to the marketplace and take more risk. And to me, that's just insane. Why? Especially if you're approaching, 62, 65, 70, and you're saying, hey, I haven't saved enough. I'm not on track for that 30 or 35% savings rate in order to maintain lifestyle, right? I now need to save more money. So let me give you an example of what I mean by that. Let's say you had $1 million and you needed 50 grand to maintain lifestyle. Well, then you only need to get a 5% rate of return. And that we could probably do so pretty reasonably. And I feel comfortable in achieving that rate of return. But if you only had $500,000, well, then you need to get that same 50, you need to be getting year in and year out 10%. So that's why I just feel that, most people are just unaware of other options. And that's why we're so passionate about making sure that your money is working for you. And think about it like this. And this is where I use the analogy of home ownership. Most of us, when we're looking to buy a home, could not afford a $200,000 or $300,000 or $500,000 house right out the gate, stroke a check, buy the house. So we take a mortgage. And so we're perfectly okay using leverage to be able to purchase an asset that we can use later. Think of Kai-Zen as exactly that. So what if you could increase your capital while lowering your overall household risk? And that's what Kai-Zen does. So here's a hypothetical household portfolio, traditional 60-40 blend, equities, stocks, and bonds, which are in the income component. If you've been on my calls in the past, I'm a firm believer of having bond alternatives. I believe in the market. I manage assets. We at Professional Planning Services believe in the market and having and achieving a rate of return. But again, how we do so and how can we do so safely as we approach retirement? So there are different ways to approach this problem. And one of the solutions that I think should be considered is adding Kai-Zen. So it's just, think of it, even though I've already sort of alluded to that it's permanent life insurance and it's an index universal life insurance, and it's specifically designed and been stress tested, which we're going to talk about, but now it's an asset class. So just like you would have used stocks or bonds, now we're adding an uncorrelated asset into our portfolio to be able to achieve a rate of return. We just have to understand, how does it work? What's it going to do for us? And then ultimately, the question I always get is, what could go wrong, right? So when we think of index universal life, it's a permanent life insurance contract. It has cash value and death benefit. It's guaranteed principal protection, and the interest is tracked to a market index. It is not in the market. That is a key differentiator. We are not in the market. The insurance companies are taking money that they could have offered you, right, in their bond portfolio, 5-6%. So we'll just use 5%. Let's say that they could have turned around and put $100 into a bond portfolio and get 5%. you'll turn around and say, okay, instead of giving you that 5%, we'll give you nothing, but we'll buy a call option on an index. Then what you're doing, so the first part of the equation is part of your initial premiums are going to fund the actual life insurance. And that just goes towards the expenses, right? And what we're trying to do, and just think about this, and I use my hands when I speak. The IRS allows under section 72E and 7702 of the Internal Revenue Code, allow you to put in as much cash and buy as little life insurance. So we're keeping our expenses as low as possible. So I have an environment so that the cash can not only grow in a market-like environment, and I can take it out income tax free. Really, really powerful. So as we're continuing to fund it and it's going over the years, it's optimized for cash accumulation. So, and then lastly, as we turn around, the life insurance then provides a tax-free death benefit. And like I said, death is always premature. So as we're going through this, that you have that protection element. And a lot of people, you listen to these radio commercials as you're driving down the road and, Big Lou, I'm on my second wife too, but it's term. And term is a true expense. You have no other component where I think the strategy, the wisdom, and really it's the greatest gift that Congress has ever given the American taxpayer is the what happens to the excess cash. And that's what's so powerful. So the death benefit provides access to living benefit riders. So it's not, you don't have to die to benefit from this. You can have chronic illness added to it, critical illness riders added to it, terminal illness. So now you not only have you created leverage, but you can access some of that cash should life happen. So again, and I will tell you that typically the cutoff point for anybody on this call, if you're really seriously thinking about utilizing the strategy, two things that are critical to understand whether you're a candidate. And that's why I said, maybe you're not a candidate on this call, but maybe you know somebody. If you have a family member that is a high income earner, that is putting money into their 401k, right? And typically about I'll say the amount is about 25 grand for 5 years would be the least amount to buy X amount of insurance based on your health and your age and your sex, right? But think about it like this. If you're over 60, probably not a candidate. Very rare exceptions. Like I said, the client that I just did putting in $250,000 a year, right? He's 57 and got preferred plus, right? So if you have health issues, if you've had a stent, if you've had a stroke, probably can't get this because the cost of the insurance is too great that we can't overcome it, right? But if you're in your 40s, your 50s, and you're high income earners, this is something to be looked at. But the second component to really understand, when somebody says to me, hey, should I do this? Understand that you can't really touch the cash, just really like in your 401k for 15 years, because there's a lien on this account because somebody is lending you money. And this is where the beauty and the leverage comes in. So excess contributions, you have the opportunity for growth. And then as we go through, your growth potential starts to work. And that's how the IUL and the perfect. But what if I can get it? If you've ever heard how people get rich, it's using other people's money, right? So if you want OPM opportunities, you need to turn around and understand we need to be able to take this. Well, first of all, before I get into how we fund it, let's talk about how it works. We're not in the market. So when the market goes up on January 1st, see, there's a floor and there's a cap. So when the market goes up, and it goes above the cap and he's going up, the little piggy, right? It's going up, and then the market during the year went down and then it went up. And one of the things I really do like about one of the carriers, there's just something called index lock. So if we get to a point where one of the indexes you're in, you can actually lock in the rate so you don't have to worry about it. So we don't have to worry about it dropping back. But you'll see here in that example, it stopped at the cap, and that's what your account is credited, and then rinse and repeat. We are not in the market. But not every year is a plus, right? So now the market turned around and went up, it went, and then it went down. And it's sort of like today in the last couple of days, right? So the market was up, we have volatility, and if your contract was below, you stay, zero is your hero. So you can't lose money. And then lastly, right? So let's talk about what a difference a 0% floor would make. So if we look at the historical market returns, right, of the S&P with dividends, right, that it's been 9.82%. If I take it without dividends, 5.89%, which is pretty close to what we could get in a bond portfolio. So you could be in the equities and you could say, hey, I could do this. And you go, well, whether I get it with dividends or without, woohoo, who cares, right? But what if you could remove the losses? This is the S&P, the history since the beginning of time, right? If I could turn around and eliminate all those down years, that changes the 5.89% to 12%. Pretty significant, right? So now we get this upside potential over time. Well, now let's talk about averages, right? So if I just take the last upside, 10 years of the upside, the actual caps, we would have gotten 82% of the upside. And if I go back over all years, 87%. But let's be conservative. If I only get 80% of the return, well, now I can turn around and 80% of the 12.32, I can get a contract where we can reasonably expect 9.85. We're only illustrating, 6.5, right? Long term, and it's been stress tested. So how do contributions and combined totals work? Remember, this is leverage, just like you got with the mortgage. So in year one, you turn around and you put in your contributions. In this example, you put in 50 grand and the lender put in 34, 35 grand. Years two, all the way through years 1 through 5. And this is where I talked about what could go wrong. What could go wrong? And I've been through this with a fine-tooth comb. Really, the only time this plan does not work is if we come up with a number, in this example, 50 grand. 50 grand times 5 years is your money. 5 years, that's 250,000. If you come back to me in 3 years and go, Chris, I don't want to do it. I can't do this anymore. You're going to get hurt. You're just not going to get back. You put in 150 grand in this example, you're not going to get back 150, maybe get 120, because the lender and the insurance company have designed these contracts to make them whole first before they're going to lend you your money. But it really is, when you look at it, you're almost getting 3-to-1 on your money. So you put in your 250, at the end of the lenders put in 600 for a total amount of money into the contract of 842. That's at the end of 10 years. At the end of 15 years, the loan is relieved and you're able to turn around and the rest of the cash is yours. So real quickly, you put in 50, the bank puts in 50. Like I said, just roughly, this is hypothetically. Now, the cost of insurance internally, we're keeping the cost of insurance as low as possible. You'll have an annual cash value of 95,000, right? Now, your cumulative in year one, 95, total loan is 50. You have a surplus of 45 working for you in an environment that can grow without market risk and now is growing income tax free. Now, you turn around year two, we do the same thing, rinse and repeat. You put in your money. Year three, same thing. At the end of 5 years, right, you put in your 250, you've turned around, they put in their money, and you have a surplus of cash turning around working for you. If we just look at the loan payment at the end of 15 years, right, we're just saying basically you have a lien on the contract of 814,000, but an estimated cash value of almost 2 million in this example. That differential, that excess cash, just think of it like the house that you ultimately, when you paid off your mortgage, you now have the asset that has grown, that is yours to do what you want to. So here's what really I think is the differentiator. I've looked at other premium financing. I am risk averse. I don't like most premium financing. I think it's misunderstood. I think that most advisors that talk about it, I hate when they turn around, they show illustrations of how good it's going to look, and they were doing it in a low interest rate environment. They have not stress tested. But here's what I like about it. There's no credit checks. You're not having to fill out an application. With traditional premium financing, you have to be a high net worth individual, an accredited investor, and you have to have good credit. Not in this case. There's no loan documents. So I don't have to. I was talking to somebody the other day that they were thinking about going, they needed money. Well, you got to go down to the bank. If you're going to pull money out of your house, you don't have a home equity line of credit, you have an emergency, you got to go down and apply. You have to qualify. Not with this. After you take the medical and you're able to step into this contract, the insurance company and the banks are taking all the risk. And there's no out-of-pocket interest payments. So it's all running in behind the scenes. But again, and one of the programs that they have that answers all your questions is an interactive learning tool called Ilya. And then lastly, and this is key, no personal guarantees. You're not having to sign over another asset or put in saying, hey, a promise to pay. If for whatever reason, Armageddon hits and the world goes to hell in a handbasket, you have no obligation. Like I said, the only thing that you have at risk is your initial contributions. Think about that compared to your 401k. In the market, you got zero protection or guarantees, and the market loses 20, 30, 40%. Oh, well, that's normal. That's why I say people that push back on this, really, when I say to do an apples to apples or a fair comparison compared to other alternatives, I think that this is the greatest and safest strategy as another asset class. So here's the last component, stress testing, right? Well, I'm not just saying take my word for it, right? In the 1980s, and one of the things Kai-Zen and NIW have done is they've gone back when Paul Volcker, I mean, we were at the highest interest rate environment in our history, right? Jimmy Carter years, right? And then even then, right, they've gone back and each chairman since then, we've looked at this and stress test this. All we need to do, get a differential of less than 2%, right? And we've been in since inception, we've been at about 1.7, right? Even with all the interest rate fluctuations, all we need to do is get a net spread of 2% on the borrowed funds, and we're in the green, right? So it's been stress tested, back tested through the worst environments. And I think that not only in the 1980s, but the Great Depression. So that's why I'm that passionate, that comfortable in making this recommendation. The only thing is you have to be able to pass a medical. Lastly, so when we talk about the solution, household portfolio, it helps reduce the overall household risk. It helps you to meet that 30 to 35% of additional revenue you should be putting away for your retirement. And then basically you get potential for like 3 times growth. It minimizes your downside risk from market movements, provides, and this is key, it's the taxes, it's the taxes, it's the taxes. Provides tax-free income source in retirement. And then ultimately, we're all going to meet our maker. I choose to call mine God one day. It will leverage and pay to our beneficiaries income tax-free. So it really is powerful. So it will help us to reduce a lot of the risks along the way. If you'd like to learn more, if you think this is something that either you or a family member or a colleague, somebody, a neighbor should look at, just have them watch the video. Have them contact us. We're happy to help. I'm going to be doing this call once a month because I am that passionate about it. This is Ilya, the interactive learning information assistant. One of the things I liked about this is that, so many times you spend so much time trying to present the information and people learn differently and at their own speed. This tool, all you have to do, no pressure. I'm a fiduciary. All I'm going to do, you send me a request. I'll take your email and send you a link. We can hop on a call or not hop on a call. I'll show you how it works, but all your frequently asked questions are right there. Any possible objection or question you could come up with is answered, and you could slide rule, hey, maybe for you, maybe it's 25,000. I'm doing a buy-sell agreement for one of my clients in a business, and we're looking to put in for each of the brothers 50 grand a year, right? 250 for each of them so they can protect the business, their spouses. It's just using tax law and strategies differently than what most people do. I really am a fan. Lastly, I mentioned that I have some Social Security classes coming up. I would encourage you to register, come see us. You can't learn less. Nothing's going to be sold. But Social Security is complex, just like the topic we went over. Retirement planning, you have to get this right. And like I said, you don't want to shit on yourself. I'm working with a client right now that they're now 66, they're still working, and they're turning around and they're going, you know what? Maybe we should take Social Security, we shouldn't, maybe we're still working. There's so many variables. Lean on us. asked me, and I said I had took great pleasure in saying to the client today, she goes, "How much is this going to cost me for you to do this analysis?" And I went, "Zero." It's not that I don't work for free, but I'm willing to do this for people that are willing to take their retirement seriously to run a model. There's really nothing but a small amount of time for me to collect data from you, analyze it, put it into my model. I have a financial planning team we can review and look at, integrate Social Security into your component, help you to decide when the correct time to collect Social Security could be. And then we could look at other risks that maybe is in your overall picture that you're not aware of or you didn't know how to solve. Those are all things that we do at Professional Planning Services. So I hope this all made sense to you. I know I went it a little bit fast paced. Yeah, I took 25 minutes there, so not too bad. I see three questions here, so let me just take a second before I go any further. I want to make sure I answer everybody's questions. So let me just look at this real quick. What do I got? I got that design. Yeah, so Ilya, so that was just Caitlin putting in. So cool. All right, so I think I covered everybody's issues or questions. These are disclosures. Just understand that this Kai-Zen, unlike if you put money in a bank in a CD, it's FDIC insurance. When we're talking about strategies using insurance companies, it's backed by the full faith and credit of the insurance company. It's not backed by the government or Social Security, right? So we use A-rated companies, and so I think much safer than traditional S&L savings and loans and banks over history. Lastly, here's my last disclosure. I hope everybody's well. Looking forward to speaking to you, and have a great day and a great weekend.